Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to look at a bunch of different data out of TradingView. It's some things that I look at. I put it together for everybody to view here and give you my financial opinions on what the market looks like. So we're going to dive in here. This is going to range from commodities, real estate, money supply, total bank credit, and ratios mixed across this whole thing. What we're trying to do is we're trying to determine what the market conditions are. The market conditions is what things are being traded under. So, for instance, humans behave differently in an inflationary environment versus a deflationary environment. They prefer different assets under those two market conditions. If one can accurately identify where one, the value is in the market, and two, the market conditions that's going to cause money to rotate a certain way, and basically that money rotation is humans being subjected to certain conditions. Much like you would think, if a human is in the desert and they are thirsty, the value of water increases. The desert is a market condition. Conversely, if they are in a completely different scenario where they're in extremely cold weather, they may value clothing more than they would water. So the value of certain things in that market changes based off of the market conditions that the humans are subjected to. And those market conditions can also change interest rates, which has a function of pricing assets. So we're going to look at some of the market conditions, not all of them. I'm just going to look at some, give you my opinions around it, and perhaps I'm looking at things maybe differently. So let's look at some of the information, and we can do this all together. So what I'm going to start with is just the global price index of all commodities. It's just a blank chart. We can obviously see some things. The last real estate bull market in the expansionary phase was this. Okay, and here's another expansionary phase of the bull market that has started, but hasn't ended yet. Why do I know it hasn't ended yet? Because we had a large supply of homes up here and we have no supply of homes down here. That is how I know. We also have a consolidation period. You can I'll just throw it in there. Generally speaking, there's your consolidation period in the middle. This here, if you look at history, that consolidation period is the recovery phase of real estate. And this basically aligns with the market conditions of the real estate market and where we are in that cycle. Commodities are preferred under the expansion phase of the real estate due to the increase of inflation and the increase of interest rates. And we also have that occurring now. So this is the global price of index of all commodities. This is what it looks like. Moving on to the next one. This is the United States Consumer Price Index. We back up. We can see a couple of things. It says the expansion phases of real estate have higher consumer price index values. We can see it kind of kick up, and then we go into another kind of trend. We kick up a little bit, pull back, and we go into another trend. Now we're starting to kick back up again. This here, this actual movement lower is a disinflation, deflation type period. That's from the real estate market, and that's from loans and credit collapsing. So if we were to look at something, what it would be a leading indicator would be total bank credit would be collapsing in the 2008 timeframe. And we'll take a look at that later on. But this is what the consumer price index looks like. And if I were to do an observation here, we've got a low graph here. We've got an increasing trend here. And then we have an increasing movement in the consumer price index, which means that over a long period of time, we are seeing the rise over run, which is your equation to fit a if you were to fit an equation on here, you would see that the slope of the curve is increasing with time. That's what that curve is. It's rise over run. And right now we are rising a lot faster than we are running. Put it that way in this circle over here. So inflation, or the consumer price index, I should say, is accelerating on this chart. Now here's the M1 money supply, money stock. And we can see that we've got a decline in M1 money stock. And I know a lot of people are talking about this. We're going to talk about it in a little bit. That's base money. This is United States housing starts. Bull market is from the yellow to yellow. Expansionary phases, bull market in commodities. And we are in another bull market of commodities, I think, coming up. And I do think that the United States housing starts are going to increase or remain at an elevated level over time. What that does is those new loans against new homes is inflationary, and that inflation comes into this system. We can see that inflation in total bank credit. Total bank credit. So credit is money, and money is credit. More credit equals more money in the system. More money in the system equals more inflation. So the more that they lend in the system, the more inflation we get in that system. Here is total construction spending in residential in the United States. We can see that we've dipped a little bit here, but we're starting to come back higher. We'll see where this goes, but right now, this is what it looks like. A bubble is when this turns and does not basically recover. This is the peak of 05, 06. So you're going to start to see total construction spending roll over. You'll see employment roll over, and all of those things will roll over together. What that means is that the housing market is basically softening. So we can see it in the housing starts. We can see it in total construction spending. We can see it in a variety of different things that we can look at. This has rolled over, and we're looking to see what happens next. Generally, what you want to see is an alignment. You want to see an alignment where the housing market rolls over, construction spending and construction employees roll over, and you have high inventory. We have low inventory and no rollover in our employment. And I'll show you that here coming up. Here is all employees construction. So if we were going to have a slowdown and you were an insider for construction, why would you be hiring now if there's going to be a bubble? If there's a bubble and you see a slowdown in your order book or whatever it is, you would stop hiring people. But we are continuing to add more employees to construction, which makes me think that we do not have a housing market bubble. It can also be associated with other construction projects as well, which is associated with bringing back manufacturing to America. This peaked out in 2006 when it rolled over. It started coming back down in 07, and we had about a year ahead of time before this really hit the fan over here. So right now, I know people are worried about a recession. I know about all that. And we very well could have a recession or a pullback, but I don't think it's being caused from the real estate market, at least not from this data currently. Here's total construction in the United States. And what we're seeing there is no pullback. We're seeing an increase in the total construction in the United States. We saw total construction really turn and roll over in that the period that we had a deleveraging. That is 06, 07, and then 08 was here when we had the crash, was on this move lower. And then we recovered. We created a kind of a little bottoming pattern, broke that downtrend, and started moving back up again. So we don't see it in total construction in the United States. That's a good thing because construction does hire a lot of employees, and we just looked at that as well. And both of these things are, at least right now, going higher. If we look at a long-term United States inflation rate, we can see that we've got a trend line that we've hit our head on here. We're pulling on back. And what I'm curious to see is if we actually break out of this to the upside. What that would mean is that inflation could go into a very large upward trend where it continues to get worse and never gets better. Maybe not never, but it'll go into an uptrend. That is something I'm looking for. I'm watching for it. And that could mean that we are hitting resource depletion, which could be one of the things. Or it means that our credit is growing at an unsustainable rate in comparison to GDP. Something on the lines of those things. This is the producer price index divided by the consumer price index. And this is saying something very similar. So if you look all the way back in the 1950s and where this chart started in the late 40s, we've been in a decline of this. And what that means is that your producer prices have always gone up at a slower pace than the consumer price index. Basically, what it means is that the companies that were selling commodities and stuff were getting fatter and fatter margins. They were doing better and better. We've come and we've put in a double bottom here, and we're starting to come back up. And if this were to go into a move to the upside and break this downtrend line, I think that would mean that we have resource scarcity and that inflation is definitely coming. It could also mean that they are creating money at a faster pace than what GDP can grow. Because, I mean, that's really what it is. It's your producer price index is basically the cost of commodities, and that's in relationship to the goods and services in the system. So if you get stuck and you cannot produce commodities and you get stuck on this side of it, it's going to go higher. And then it will slowly feed itself into the consumer price index. It means you're in an inflationary environment. So if this breaks to the upside here in a wave 3 move, you would expect this to also break and move to the upside because your commodity prices are going to be fed into the system and go up, impacting the producer price index faster than the consumer price index. Here is your M2 money supply divided by gross domestic product. And I know we've had a decline in M2 money supply. So we're seeing it roll over. So what I'm going to look at is I'm going to start looking at a couple of different metrics here. Yes, it's rolling over, but let's check some things. So here's money, M2 money velocity. So here's your velocity, and it's kicked up quite dramatically on the right-hand side. So the velocity is starting to kick up of that money. Money velocity is the number of transactions that are going through the system. So you get all this money going through the system, and the more transactions it creates, and the more dollar value transactions it creates, the faster this money supply goes up, the velocity of it. So this is coming through the system at a faster pace than what it was before. So maybe they were dumping money into the system somehow, buying financial assets, and it wasn't impacting the velocity of the money. It wasn't circulating in the system. If they were to take that money back out of the system that was in financial assets, you would, and they don't touch the money in the system, you would see this velocity kick up just like it is. So that's an interesting fact there. So this is M2 money supply divided or times the velocity. And what we've seen in this is a stark move to the upside. So what people do is they focus on the M2 money supply and they say, oh, it's inflation, or oh, it's not. Well, the real measurement is not just money supply. It's money supply times your velocity. That's what's going to basically level load the reading to a real reading of what the system is seeing. So we can see that this is continuing to move higher. And we do have a little bit of a wiggle recently from January 23 and onward, where we've seen a little bit of a dip there. So that's what money supply times your velocity will get you kind of money in the system that's circulating in the system. Well, at least the way that I kind of think about it. Gold divided by the M2 money supply, we've broken that out to the upside in the short term here. That's what it is on the lower right, but this is the bigger picture view of it. Under certain market conditions, gold can account for the money supply, and we'll see a ratio that increases during that time frame. If you look at the overall chart pattern, we have a double bottom 1 and double bottom 2, which is a very large and big chart. So it's going to take time, but it looks like we're at a very low level and we could increase for a very long period of time. and probably had a lot higher over that period of time. So we're at a very low valuation for gold, and gold has not accounted for the M2 money supply. If the right market conditions come, that's when money starts to rotate. The right market conditions is an increasing interest rate environment where people fear holding bonds and they fear the currency. That is the market condition that has shown. And what happened was we had a early 1970s peak oil back here. And I think that interjected some problems into the system where money supply or total bank credit was increasing at a faster pace than gross domestic product. That is your stagflation type of environment. You're in a slowdown at the same time that you're increasing the money supply. Stagflation is a description of a market condition. And I think a similar market condition is coming in the future, and gold will outperform the M2 money supply. Here's M2, or this is gold divided by total bank credit. It's the same chart, basically. There's your double bottom again. So it's the same chart, looks very similar, and what gold does is it accounts for the total bank credit in the system. So M2 money supply and total bank credit are very closely linked. This is total bank credit divided by gross domestic product. So what we're seeing here is when we see total bank credit outperform GDP, you've got basically inflation. We could see that it did that from 98, 99. That's when we had our commodity bull market, where we saw an increase of total bank credit divided by GDP. We also saw this happen in 2019 going forward to January 2020, and then they created all that money where the total bank credit expanded faster than gross domestic product. But right now we can see it's kind of moving sideways, and I think that's consolidating for potentially another move to the upside in the future. We also have, I'm not going to go over that one. This is the United States Case-Shiller Home Price Index. A lot of people focus on this. And what they say is, it's going higher, we're in a bubble. We're in a bubble. It's going higher, we're in a bubble. So they'd say this is a bubble and that this is a bubble. Well, I mean, okay, but shouldn't this be anchored to something? If we created 40% of money supply in 2020, which is basically right here, shouldn't we have a 40% increase in house prices to account for all that money that went into the system? Maybe, maybe not. That's just a question that I'm posing and asking to those that think we are in a bubble. If that 40% increase in money supply, it may not have jumped this much. In order for the money supply to get into the real estate market, into the Case-Shiller Home Price Index, you must have able and willing buyers in the market. So they released this money and did quantitative easing at the wrong time, because people are coming into home buying years and they can buy homes, and you just gave them the fuel to buy more homes and to become more competitive. It doesn't mean that you'll have a housing crash if the demographics still there are ready to buy. You just added fuel to that fire is what you did. This is the Case-Shiller Price Index accounting for the total bank supply. This looks like a different story. What I would say here is, if I drew a line across, and a lot of people are probably going to recognize this, this is a double bottom. We've broken out, and this is the perfect time to actually buy. It's the ideal buy point for a move to the upside, known in technical analysis. I actually think I had this back here. Let me see if I could find that real quick, because I had that on one of the charts here, and that was probably on PPI to CPI. So let me grab that chart real quick. If it's over here, if it's not on that one, it's on one of these that I had in here. There it is. So this is the chart. I'll put it up there. So this is the Case-Shiller to total bank credit, right? This is your ideal buy for an investor. Tell me that doesn't look exactly the same. You come on down, you put in a hump number one, your pull up there, hump number one, come up to the top. That's this guy there. Your other humps here. You come on up you do a retest. So A is this breakout there, B is here, and then you work your way on higher. So what this is telling us is that the Case-Shiller home price index should outperform total bank credit for a while. Back in where it peaked in 2005, we have a long way to go higher in this ratio. If I were to pick it and go all the way up, we could go up 65% and outpace total bank credit to get back to the all-time high of the Shiller Price Index. So the Shiller Price Index can outperform total bank credit by 65% and then be at a peak of that last bull market. So what I'm seeing here is bullish across the board for a real estate market boom. It does not tell me that none of these setups are bearish for inflation. They all look like they want to go higher. I can also use other data like the 40-year downtrend line that's been broken on 10-year and 30-year yields. That is also inflationary in what it's signaling. It's signaling that the house prices could still go up in relationship to total bank credit, in relationship to gold, and in relationship to the M2 money supply. What it's saying is that the home prices haven't accounted for the money that's in the system yet. And that is obviously in stark contrast to what a lot of people are saying on YouTube. But that's a fact. It's not a matter of debate. They can debate whether the housing market can go up or down. That's fine. But that is some of the facts that are behind it. What I try to do is I look at the facts and then I try to make a determination of why something is priced the way it is. The market conditions with the demographic where it's at and the underbuilt scenario in the housing market, I'm quite surprised that we've even had a pullback even though rates have gone up. Historically, rates go up and then they go into a hyper supply phase. And they will continue to go up under these market conditions. The rates really can't go lower. I mean, they can go lower if you get a recession or something like that, where something in the system needs to get flushed out of the system, or there's a scare, or there's fear. I mean, it's not impossible, but generally speaking, rates go up under these market conditions until we build too many homes and we go into a hyper supply phase and roll over. The pressure is still there and it doesn't change. And generally commodities do very well under those market conditions. So that's what I've had for today, guys. That's what I wanted to go over. Give me a thumb up for the content, subscribe to the channel, and subscribe to the website if you'd like and join our community. That's something else that you can do. And that's all I've got for today. So we'll catch you guys later. This is Finding Value.